audio. G'day and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us here at AusBiz as we get going with a brand new week. Let's first take a look at what happened on Friday. Something of a recovery on global markets. Stocks on Wall Street rose after data showed the US economy created fewer jobs than expected last month, prompting expectations of further rate cuts. Investors were further buoyed by Fed Reserve Chair Jerome Powell, who said the US economy is in good shape. The S&P 500 registered its biggest weekly percentage decline since September, down 3.1%. The Nasdaq, it's in correction, having lost more than 10% since peaking in December. It fell 3.5% last week, and the Dow lost close to 2.5%. Stocks specifically, Hewlett-Packard shares, initially fell after revealing its annual profit forecast would be hit by US tariffs. Broadcom shares jumped after the chipmaker sought to reassure investors about AI infrastructure demand with a strong second quarter forecast. And retailer Costco fell heavily after missed Wall Street estimates on quarterly earnings as merchandise costs increased. Well, US jobs growth picked up in February, but signs of weakness are emerging as trade policy and deep federal government spending cuts threaten economic growth. Non-farm payrolls increased by 151,000 jobs last month, which was less than forecast. Average hourly earnings rose 0.3% after climbing 0.4% in January. Annual wage growth increased at a 4.1% pace, and a drop in consumer spending and home building. And a surge in the trade deficit in January linked to tariffs have stoked fears of stagflation. The Atlanta Fed is forecasting GDP contracting at a 2.4% annualised rate this quarter. Meanwhile, Fed Chair Jerome Powell has said it remains to be seen if the Trump administration's tariff plans will prove to be inflationary, but said officials don't need to rush to adjust policies, saying despite elevated levels of uncertainty, the US economy continues to be in a good place. We do not need to be in a hurry and well positioned to wait for greater clarity. Well, the US two-year Treasury yield rose to 4%, while the 10-year was up to 4.3%. And the US dollar has fallen to multi-month lows against the euro and yen and fell against most currencies on Friday, following the softer than expected labour market data. The Aussie is trading at 63.1 US cents. And Bitcoin has continued to fall, to be trading at just under 81,000 or thereabouts at 81,000 as the first ever US presidential crypto summit ended with promises of stablecoin legislation and lower regulatory resistance. On the commodities front, oil prices gained on Friday but retreated from session highs after President Trump threatened sanctions on Russia if it fails to reach a ceasefire with Ukraine. Brent crude futures up more than 1% at $70 a barrel. Copper fell 2%. Iron ore up around a third of a percent to $102 a tonne. And gold little changed to $2,911 an ounce, but gained more than 1.5% for the week, with China continuing its gold buying. Well, let's get across global markets with a focus there on the States. Isaac Poole joining us from Oreana Private Wealth. Isaac, good to catch up with you. Thanks for joining us from Hong Kong. It's early your time, but we appreciate that. Let's start in the States off the back of that key jobs report we got on Friday. What did you make of that? Because certainly, I guess, investors trying to look at this positively in that it may mean more rate cuts.
Yeah, and that seems to be the way that investors are really trying to take this, that, hey, look, there's some bad news there or some clearer signs that the US economy is trending weaker. That means perhaps instead of just getting one Fed rate cut or two Fed rate cuts this year, we might get three, and maybe we get one in May. And that's perhaps a little bit concerning that the market is going back to hoping for rate cuts to help drive equity market returns, particularly when the economic data we've seen so far this year really is painting a picture of an economy that is beginning to slow.
So what are we seeing there? And I guess undermining all of this, of course, is the uncertainty in regards to Trump's tariffs, but also, and I guess this is sort of showing now in jobs data, in that we've got massive job layoffs, particularly in the public sector.
And that's the real story here. That uncertainty is usually see them slow further in coming months, and I think that's been the expectation from the administration in the US. Investors are starting to come around to that, and if we do see jobs growth slow, that's a real challenge to the household and consumer resilience that's been underpinning the US economic exceptionalism for the last 12 months or so. So that is a real challenge to the outlook, at least over the first half of this year. And what I think is a growing concern is if that does bleed through to some weakness in equity prices, then the wealth effect that's been supporting and helping the higher income earners in the US spend so much could really begin to dissipate, and that would just add an extra leg lower to economic growth in the US.
So you're saying overall there, Isaac, when we take a look at job cuts, trade policy, overall geopolitical uncertainty, that is likely to continue to undermine confidence, you think?
That's right. I think that's it's not just consumer confidence, it's business confidence that is really important here. Of course, consumer spending drives so much of US economic growth, but the corporate sector, the investment side of things, business investment really can help drive turning points, and that should be something to keep an eye on here. If businesses in the US cannot get a good read on what the policy outlook is in the US domestically, but also the foreign policy, then they will look to shelve investment decisions, and that will be a challenge to economic growth in the outlook. And at the moment, it really doesn't feel like we're going to get a great deal more clarity on that policy outlook, not in the near term, and it just means that uncertainty can percolate for a much longer period of time.
And how's that uncertainty been reflected in the equity market at the moment? Obviously, we've seen some significant falls, as I mentioned there, the Nasdaq in correction at the moment. How are you looking at those valuations?
It's an odd one because valuations are still relatively stretched, at least in the S&P 500, and yet there's sentiment measures and the sort of investor sentiment that we're seeing out there is really quite negative. Prices just haven't fallen as much as you might have otherwise expected. And so we do still think that valuations look a little uncomfortably high here. And that doesn't mean we need to see a big drawdown or a big sell-off in prices. It just might mean that we could do a lot of work trading sideways to get those valuations back to something that looks even a little bit attractive.
And what are you seeing in fixed income? Where are you seeing the opportunity at the moment?
Well, I think that it's been a bit of a mixed bag because for so long, high yield corporate credit was doing very well, but now spreads have really blown out at the start of this year. And I think that's corroborating some of the weakness in equities. For us, we've really preferred over the last 6 months to be in very high quality fixed income. That means investment grade credit, but even more importantly, we think it has been a good chance over the last 6 months to be adding treasuries to the portfolio. US treasuries, where they were trading up around 4.5 and above at the 10-year in yield terms, that was giving okay income, but more importantly, giving some good downside protection and resilience to portfolios if we did see an equity market shakeout.
And Isaac, what's your view on Asian equities, given you're in that part of the world at the moment, particularly with the focus on China? Now, in fact, yesterday we got the latest read on inflation, which did come in lower than expected.
Yeah, it's still not a clear-cut sign over here that Chinese economic growth is going to rebound, despite the target being set in around 5% in mainland China, despite some more words, at least, that there will be support. So we think that there is some valuation reasons, relative valuation reasons, perhaps for investing in Asia, but only if you've got a very solid risk appetite there, and perhaps not a time to be adding a great deal, but if you've got a little bit of exposure, you can hold because of that relative valuation.
Once again, a lot of this comes down to trade policy too, what we're likely to see in terms of response from China.
But I think there will be further responses. They've made it very clear that they won't just take tariffs being implemented without having some response. And it looks like there will be further tariffs implemented from the Trump administration on China. What we've seen so far is probably not going to be the end of that. So there is that growing risk that we see a trade war intensify and tit for the tat retaliation, and that will be a challenge, I think, not just to Asian economic growth. There'll be some winners and some losers there, but I think it means that the whole global growth outlook is likely to be dragged down a little bit over the course of this year.
Isaac, great to get your assessment of what you're seeing globally. Thanks for joining us from Oreana Private Wealth.
Thanks, Andrea.
Let's now refocus on what we can expect locally. SPI futures indicating a positive start, up close to 0.9%. That's, of course, following those sharp falls we saw last week. We'll take a look at the ASX 200. In fact, we're back to where we were middle of last year. Stay with us. The Open is just a couple of minutes away.